Hello, dear students. I am Dr. Pallavi Yeolekar. Would like to introduce a topic that is bank reconciliation statement. Now, why we are introducing this topic, bank reconciliation statement? As you are a commerce student and as a stream of a commerce, you should know about the bank and various bank statements. So, today we are going to talk about the bank reconciliation statement. Now, if we see the bank reconciliation statement, as you all know, what do you mean by bank? Bank, it is an institution who deposits some money and lending a certain type of loan. Okay, the two main function of a bank is what? It is an institution who is depositing the amount of money from the customers and lending the loan to the customers. Now, when we are talking about an institution or when we are talking about a particular entity, so every institution or every entity or every company is there to make a profit. So, bank is also an institution who is going to make a profit. How the bank is going to make a profit? When the bank is lending a certain type of loan to the customers, that time customers are paying some amount of interest on that loan, and that is the profit for the bank. We can say that is the income for the bank, and that is the reason we are saying the bank, it is an institution who is making a profit. The second thing is that when we are talking about reconciliation, reconcile means what? To finding out a statement or to finding out the difference in the statement. Okay, now what we are going to do in this topic, when we talk about a bank reconciliation statement, that time we are finding out how this statement is going to work, or we are finding out what are the differences, what are the changes that we are going to see in the bank reconciliation statement. Now, if we see about the definition of bank reconciliation statement, now very simple thing is that a bank reconciliation statement summarizes means what? It is giving a whole idea about banking and business activity. Why the banking and business activity? Take a simple example. When ABC Enterprises, for example, ABC Enterprises is running a particular business. Okay. Now, when the ABC Enterprises running a particular business, that business is going to do some transactions. Is it correct? Okay. Now, when the bank is going to do some transactions, that time business is going to do some transaction. That time, what happens? The business will do the transaction with the customers, with the suppliers, with the banks, and with the all the stakeholders. Stakeholders means what? It includes your bankers, investors, customers, suppliers, debenture holders, so everything. So when the business entity is doing any activity, so that activity is going to connected with a bank. That is the financial activity. So it is reconciling an entity, and it is a bank account, reconciling a entity's bank account. Reconcile means what? Now see, if I am doing a business, I have my particular books of account, and bank is also having their books of account. When I am maintaining a book of account, that book of account which is known as a cash book with my business entity. But when the bank is maintaining a particular book of account, that book is known as a passbook. So I am handling my cash book and bank is handling the passbook. When the entries are going to pass in a cash book as well as in a passbook. But sometimes what happen, if suppose I am doing any entry and it is unknown to the bank, so that the bank balance will not grow up or will not go down automatically, because the bank is not having any kind of information. When we are talking about a bank reconciliation statement, the simple thing is that we are just finding out what is the difference, why there is a difference between cash book and passbook, why there is a indifferences, why there is a certain we can say why there is a certain misinterpretation. Now when we are preparing this bank reconciliation statement, so we are getting an idea why the cash book statement is in a different sense and why the passbook statement is in a different way. So we are just finding out why it is not matching. Okay. Now, when we talk about a bank reconciliation statement, it confirms that payments have been processed and cash collections have been deposited into a bank account. It means what? Whenever the cash is there, we are depositing into the bank, and bank is doing the payment for the further entities. Okay, understood now? Now, if we talk about the two balances in BRS, that is known as bank reconciliation statement. The very first balance is favorable balance. Why we are talking about a favorable balance? Because see, favorable means what? It is in a positive sense. When we talk about a favorable balance, it means the balance is in a positive sense. Means we are having a more balance, we can do a more operation, and that is the reason we are talking about it is a favorable balance. Second thing is that it is unfavorable balance or a overdraft balance. When we talk about a unfavorable balance means what? I have a lots of payment rather than my receipts. So that time we can say it is an unfavorable balance, or we can say it is a overdraft balance. Okay, so two things we have taken into consideration. The very first is favorable balance, and second one is unfavorable balance. Then the next, if we talk about the characteristics of a bank reconciliation statement, characteristics is also known as a features of the bank reconciliation statement. Now, the very first is it is just a statement, not an account. Always remember, bank reconciliation statement, shortly known as a BRS, it is only a statement. It is not an account. No customer is going to open the BRS account with the bank. No, it is just a statement which shows the difference between cash book and passbook. And it is only a piece of paper on which the record is maintained. It is not any kind of account. Okay. Now, the second thing is that it is prepared at a periodicity decided by the business entity. Why the periodicity? Because when the business entity want to make a BRS, so that BRS is going to prepare for a particular period of time, and that is the reason it is known as a periodicity. So when we are talking about a periodicity, why decided by the business entity? Because see, when the business is running into the market, that time n number of activities they are carrying out, and when they are carrying out a different number of activities, that time they are having a lots of transactions. So with the help of this lots of transactions, the business is having a certain transactions with the bank as well. And when the business is having a transactions with the bank, it means what? Bank will also enter a some amount of transaction, and business will also enter a some amount of transaction. So sometimes it happens that when the bank is entering some transaction, might be the business is not entering the same transaction, or might be the vice versa situations will be there. Business is maintaining some transaction, whereas bank will not maintain that because bank is unknown about that transactions. So it is known as it is prepared at a periodicity which is decided by the business entity. Now the next is its validity lasts only for the day which it is prepared. It means what? When the business is preparing a BRS, that time business is preparing a BRS and it is valid only for that particular date. Now you will ask me why it is there, why the reason is it is only valid for a particular date. See, when I am doing a business, I am taking a 10 transactions in a day. Okay. So that 10 transactions I am matching with my passbook, means I'm matching cash book with my passbook. Okay, now it is correct for a particular day. Now after a day, if I am doing a 15 transactions, or if I am doing a rather than less than 10 transaction, but my transactions will be different. Okay, so when my transactions will be different, my entries will be different. So that is the reason I am saying that when I am doing a business, I am doing a transaction, and when I'm matching with cash book and passbook, it means what? It will be valid only for that day, because next day no one knows that which transaction is going to take place, and because of that we cannot say that it is going to valid for a next day, because it is only for that particular period. Okay, now the next is it does not form part of double entry bookkeeping system. Now we have already seen what do you mean by double entry bookkeeping system. When we are doing any accounting transaction, that time we are giving a two effects always. First is debit effect and second is credit effect. So when we are talking about a double entry bookkeeping system, it means what? We have recorded a transaction in a debit balance also and in a credit balance also, so we can match that debit balance and credit balance. But when we are talking about a BRS, we are not keeping as a double entry bookkeeping system. So what we are doing, we are just maintaining a cash book as a business entity, and bank is maintaining a passbook as a bank institution. So when we are doing a transaction or when we are entering any transaction in a cash book, we are just recording in a cash book, but we are not recording in a passbook because the bank is going to record in a passbook. Okay, is it clear? Now, the next is it provides reasons for mismatch between passbook and cash book. Now, the same thing is that it provides a reason. Now, we are finding out what are the different reasons why there is a mismatch between cash book and passbook. Why the mismatch? Because see, when I am doing a transaction in a books of account, that is in a cash book. So I am as a business entity, I am recording my all the transaction. For example, if I'm making any kind of payment to a third party, so my balance is getting down, okay, but it is not known to the bank. So what is that? The bank balance will be only X amount and it has not decreased. So what is that? My cash book is showing a less balance, but my passbook is up to that level only. So we are just finding out what are the different reasons why there is a misbalances between cash book and passbook. Okay, understood about characteristics. Now we will go ahead and we will see what are the different objectives. Objective means what? Why we are preparing a BRS, why there is a need, why there is an objective, why we are preparing a BRS. The very first objective is to highlight the causes of differences. Highlight means what? We are just finding out what are the causes, why the differences arises, and that is the reason we are preparing a BRS. Because when we will prepare a BRS, we will understand what are the different reasons, what are the different things through which we can find out why there is a difference between cash book and passbook. Then the second one is to minimize the chances of fraud by staff. Chances of fraud by staff means what? See, every company is having a certain amount of staff. Okay. Now, when we are talking about a staff, it means what? It is a human being. Sometimes fraud can be there. Sometimes misstatements can be there. And if we are doing or if we are finding out the differences between cash book and passbook, so obviously it will reduce the chances of fraud. No staff will do the fraud because staff is also knows that okay, passbook and cash book is going to be match. So obviously the entries will be there. Obviously we will find a certain transaction where it has happened, on which date it has happened, and for which amount it has happened. So that is the reason it is minimizing the chances of fraud by the staff. Now the next is moral check on staff. Moral check means what? See, in life, every human being is carrying certain values and carrying certain moral characteristics. So if I am working for my company, if I'm working for my particular department, so I have a moral values. I know whatever I'm doing a work, I will do in an honest manner. I'll not make any misinterpretation or I'll not make any kind of mistake when I'm doing a work. So what is that? We are through the BRS, we can find out what is the moral of the staff. The next is detection of errors and omissions. Detection of errors means what? Errors means what? These are the certain, we can say the wrong things. Okay. For example, if I want to enter a amount of rupees 1000 and by mistake I have entered that amount of rupees 100 or a 10,000. So what will happen? If I'm reducing a 10, the amount suddenly get down, and if I'm adding a 10, the amount is suddenly get up. So what is that? So I will detect what are the different errors I'm facing in my cash book and passbook. For example, I have done an entry in a cash book that is 1000 rupees. Also, the bank has done an entry that is rupees 1000. Okay. Now, if by mistake I have written 1000 as a 10,000, so what will happen? My balance will go up because of 10,000. So my cash book balance will show a more balance rather than my passbook. So what will happen? This is a error. This is the error between cash book and passbook. So I am minimizing or I am detecting that error and I am finding out where I am doing a wrong things or when where I am doing a wrong entries. Okay. The second thing is that omissions. Omission means what? For example, I have skipped something. Okay, omission means we are just uh, taking out or we are skipping that. Okay, and skipping that means it is not knowingly, unknowingly we are skipping the any transaction. For example, I have a 10 transaction to record in my cash book, but by mistake, or take an example ki because of any reasons I have just entered a 9 transaction, and by mistake the one transaction is skipped from my cash book, but these 10 transactions same return in a passbook. So what will happen, my passbook will show a different balance but my cash book will show a different balance. Because of what? Because of omission, because of omission of error. And that is the reason I am finding out why there is a difference between cash book and passbook. Then the next objective is future plans. Why the future plans? Because when I know what is my cash book and what is my passbook, it is more easy for my company, or it is more easy for me to know what is the position of business entity, what should be done, what are the different sources, what are the different things that I have to do, what are the different transactions that I can make with the bank. So what is that, I can do my future plans for my company, and through which, through BRS, because when I'm doing the BRS I can find out my future plans, I can do my future plans. Okay, understood about this? What are the objectives? Now, who prepares BRS? Who is going to prepare the BRS? The very first is business concern. Business concern, why? Because when the business is recording their transactions, they are matching that cash book and passbook. So, very first thing is that business entity, or we can say the business concern, which is going to prepare a BRS. Now, who is the second one? The second one is bank. When we are talking about the bank, it means what? This is an institution which is going to maintain our amount of balances with them with the help of passbook. And same, we are also maintaining the same thing but in a cash book. So always remember, when the business entity is maintaining with the cash book, and when the bank is maintaining with the passbook. Okay, now what are the different causes why there is a difference between cash book and passbook balances? The very first, we can see what is the cause? The very first is check issued but not presented for payment. Now, see, if I am a business entity, I am issuing a check. Okay, when I'm issuing a check, it means what? I have to do a payment to the third party. So, that is the reason I have issued a check. So, when I'm issuing a check, my balance is getting down. For example, I have a 100 rupee of balance. Now, I am issuing a check of rupees 20. So, my balance is getting down, my balance is 80 rupees, but my passbook balance is 100 rupees. And now my cash book is getting down because I have issued a check, but it has not cleared yet, or it has not presented for the payment, because that check will go through the bank and it has not presented. Means what? The bank is not having any information yet. That is the reason my passbook is showing a more balance. So there is a difference between cash book and passbook. So this is one of the reason. Second reason is check deposited into bank but not yet collected by the bank. Check deposited means what? I got a check from the third party. So, for example, I got a check of rupees 1000 from the third party. So, my balance is going up because I have got a check. So, my cash book balance is getting high. But what they have given, it has not collected by the bank. So abhi tak bank mein collect hua hi nahi hai. So what is that? The bank will show a less balance because it has not collected by the bank. Again, there is a difference between cash book and passbook. Now, the next is bank charges. Bank charges, it is very simple thing, is that bank is applying certain kind of charges to the customers or to the business entity. What kind of charges the bank is having? Bank is having a charges for maintaining an account. Bank is having a charges for the ATM. Bank is having a charges for checkbook, issuing a checkbook. Bank is having a particular charges for any kind of charges. For example, if a business entity will have a certain new transaction, so for that bank will say that yes, we will do this transaction, but we will apply certain kind of charges. So what is that? This is also a bank charges. Bank charges means what? Bank will charge a some amount of money, so automatically bank will deduct the amount of money from your account. So when bank will deduct the amount of money from your account, your balance will go down in a passbook, but you don't know about the charges, so your balance is cash book is up. So there is a difference between passbook and cash book. Okay, now interest credited by bank but not entered in a cash book. Interest credited means what? It is a some amount of income which is credited by the bank to our account. So when we are receiving certain kind of interest, it means what? It is an income for us. So when the amount is credited by the bank, your passbook is going up, but you don't know about the interest. So your cash book will be at this position only. Whenever you will get the information, then only you will go up. But right now you are not having any kind of information. Only the bank has deposited amount of interest. So this is the difference between cash book and passbook. Now, the next is interest or a dividend on investment collected by the bank. Now, for example, you have done a certain kind of investment. Now, in this investment, you are getting a certain amount of interest. For example, you have done a fixed deposit. Okay, for the fixed deposit, always for the fixed deposit, you will get an interest on that fixed deposit. So, what is that? Your income is getting up, but you are not having any idea in a cash book. So again, there is a difference between passbook and cash book. Okay. Now, amount directly deposited into the bank by customers. So here, what happened? If suppose uh, we are we are going to get a payment of rupees 1,000, but that customer has deposited a amount of money directly into our bank account. So when the customer is depositing the amount of money directly into a bank account, it means what? Bank balance is getting up, but we don't know any idea about what the customer has done. So our cash book balance is at that level only. So when we will get an update from the bank, then only we will increase the cash book. So again, there is a difference between passbook and cash book. Okay. Now, if we see, the next reason is payments made by the bank on behalf of clients. Payments made by the bank means what? Suppose, for example, I have a 10 clients and I'm going to make a payment for my 10 clients. But I have given the instruction to the bank that yes, on this date, please do the payment of my clients. So what the bank will do? Bank will do the payment on time because bank know this date is given by the customer. So bank will do the payment, but suddenly when the bank will do the payment, your passbook balance is getting down, but your cash book is here only. So again, there is a difference between cash book and passbook. Then next is bills collected by the bank on behalf of customers. Now, there are certain bills which is collected by the bank. When the bank is collecting your bills, obviously bank will credit that into your account. So your bank balance will go up, your passbook balance will go up, but your cash book balance is here only. So what is that? This is the difference between cash book and passbook. Now the next is dishonor of bill or checks. Why there is a dishonor of bills and checks? As you know, what do you mean by dishonor? Dishonor means it is a particular reason through which that check has not passed. Now, what are the different reasons why the bill is dishonored? Because when there is a insufficient balance, or if might be any wrong information is there, if might be any wrong signature is there, if might be any kind of reasons. So when the bill is dishonored, there are different reason behind the bill dishonored. So when this bill is dishonored or checks, that time your balance is going to mismatch. Again, you have to match that passbook and cash book. Now the next reason is rebate on retiring of bills. Rebate means what? See, for example, I have taken a loan from the bank. Okay, when I'm taking a loan from the bank, my maturity date is 31st December. Take an example. This is my maturity date, that is 31st December. So, for example, if before that 31st December, I am doing all the payment to my bank. So, what is that? Before the maturity, I am doing the payment. So, when I am doing the payment before the maturity, it means what? Bank is giving me certain kind of incentives on that. Because what? Because I am doing a payment before the maturity. So when the bank is crediting or bank is giving a certain incentives, that is known as it is a amount of rebate, and that is going to be credited in a passbook. So your passbook balance will go up, but your cash book balance is down, and that is the difference between passbook and cash book. Next is checks paid into bank but omitted to be entered in a cash book. Now, what happened? A businessman paid a some amount of check to the bank, but by mistakenly it has omitted in a cash book. Omitted means what? It has not entered in a cash book. So you have paid the check, but it has omitted. So your balance is not getting down, but passbook balance is getting down. So what is that? There is a difference between cash book and passbook. And the next reason is wrong debit or a credit given by the banks. For example, I have done a particular entry. I have purchased a particular machinery for a particular amount. So this amount I'm going to do amount in a debit also and amount for the credit also. So what is that? When the bank is doing a wrong credit or a wrong debit, that time sometimes cash book and passbook is getting mismatch, and that is the reason we have to match that passbook and cash book. These are the certain reasons through which we can find out what are the different, why there is a difference between passbook and cash book. Is it clear to all? Okay, thank you everyone.